Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, renowned gold expert James Turk of goldmoney.com. Also, got a new book out called The Money Bubble and What to Do Before It Pops. James Turk, thanks for joining us today on USA Watchdog.
Hi, Greg. Great to be with you.
We'll talk about what to do before it pops and a little bit about your book at the end of the interview, but I want to start off with Russia. And, you're a precious metals investor. You have to look at the geopolitical situation I know you do. I know this is a big deal. We're going out of our way, from the president on down. The military option is off the table. Putin and everybody on down from him is saying, oh, the military option's on the table. Oh, yeah, it's on the table. You do something to these Russian Ukrainians and we're coming in. What do you think is going to go on in terms of the Russia, Ukrainian, the U.S., EU, the deal where they're going to have sanctions and not really wet noodles, these sanctions? What do you think? How does that affect the gold price?
Well, whenever there's global tension, people go to safety, and one of the greatest safe havens of all time has been gold. It's been money for 5,000 years. It's still money. It's still a safe haven. Because it's money that doesn't have counterparty risk. It's money that's outside the banking system. And to give you an example, in Cyprus, people who owned euros in the banking system lost a lot of money. But people who owned gold, did very, very well. So, gold does respond to geopolitical tensions. And I must admit, the situation in Ukraine is getting more serious. And I would not be surprised if the tensions continue to rise, given the rhetoric that we're hearing from all parties who are involved.
Could a war there turn into a rout for the global financial markets? The EU is not doing great. They have a lot of teetering banks. They've got a basis or a format already laid out for bank bail-ins if things, crash. Could this be an accelerating, a trigger point that could cause, some great distress in the global financial community?
Yeah, it really could. This could blow out of proportion very quickly, and it would be much more serious than what happened in the Balkans, for example, where there really was a shooting war. But what's happening here is you're talking about, a major economic power, and the use of sanctions. And by coincidence, I was just watching a documentary on the beginnings of World War II. And one of the causes of friction between America and Japan was the economic sanctions that the United States imposed on Japan because of their incursions in China. And it was eerily similar to what's happening now in Russia. And I think the stakes are just as high when you're talking about two major powers confronting themselves in this way.
Well, there was talk about going after Putin's money, which some say some of it might be in Swiss bank accounts, but neither here nor there. And his response was something to the effect, I don't have the exact quote, but close to it, and that was, the West could cut their nose off despite their face. In other words, he's going to have a response to that. And they're already going away from the dollar in trade. China has 23 bilateral agreements around the globe. They want to use the yuan in global trade. And clearly they have these agreements with Germany and the UK and all these other countries have these agreements. And it just looks like the U.S. is in a very weak position in terms of sanctions. And it looks like they've kicked over the tar bucket and there's no getting it back in the bucket.
Yeah, you're absolutely right. And to do it in an environment when economic conditions, both in the United States and in Europe, are very weak, is even a little bit more worrying, because you don't have the economic base that you would during a period of strong economic activity. You have to remember that these sanctions can bite home. People who live in glass houses should not throw stones, as the old saying goes. And the issue here, Greg, is that there's so much debt and party risk between various players in the global economy that it has a knock-on effect. And we just don't know how that knock-on effect is going to play out. But if you look back to 2008, during the financial collapse then, at the early part of the year, we saw Bear Stearns get in trouble. Then a couple of European banks were getting in trouble. And then ultimately Lehman went over. It fell apart, collapsed, and that had a knock-on effect as well. we just don't know how it's going to play out, but it is very worrying to see these threats of economic sanctions and imposition of sanctions and the war of words going back and forth. It is potentially very serious.
If Russia invades Ukraine, even just limited invasion to eastern Ukraine, are we going to see the gold price spike?
Well, I would think so. But, given the fact that central banks have had such a heavy-handed pressure on the gold market in the past year or so, it might be a delayed reaction. There might be a sell-off by people who are looking to sell some gold to raise liquidity elsewhere. We just don't know how it's going to play out. But what I do know is that as long as central banks are printing, and they've been doing this week in and week out, that's debasing the national currencies, and that means ultimately the purchasing power of gold is going to go up. And I like to use as the example the price of crude oil in terms of gold. Back in 1999, when gold was $250, the gold price has risen just over 5 times. Crude oil was $20 back then. It's risen over 5 times since then. So an ounce of gold still buys the same amount of crude oil it did in 1999. And for that matter, it still buys the same amount of crude oil it did in 1960. So my guess is that if you get geopolitical tension and Russia threatens to, do something on the energy issue, crude oil will go up, gold will go up as well.
Aha, so gold may drag up, crude oil may drag gold up and not the other way around.
In other words, the central banks can't keep the gold price going if the crude price goes up. That's right.
Yes, and they're threatening to use that as a weapon. And you were talking about how the central banks could run out of gold this year. Why do you say that? You said that on another interview. Why do you say that the central banks can run out of gold this year? How do you know that? What are the markers?
Well, there are markers out there. I don't know it for a fact, but there are markers out there that we can look at and make a logical deduction. And the thing that I'm looking at primarily is, well, there are 2 things. One is that there are reports of a lot of old gold bars coming out of the vaults going into the refiners being turned into kilo bars for shipment to Asia. And the fact that they're old bars, these are bars refined 30, 40, 50 years ago, back in the 50s, 60s, and 70s, suggests that they're at the back of the vault. They're not at the front of the vault where the newly refined bars would be. But more importantly is the backwardation we're seeing in gold. In other words, this is a function of interest rates. Because gold is money, it has an interest rate. And because it cannot be created on a printing press, physical gold has the lowest interest rate of all monies. And mathematically, without getting into the complexities of it, means that, the gold spot price is always less than the future price of gold in the future. If it isn't, the arbitrageurs can come in and eliminate the backwardation that would otherwise occur if the spot price were higher than the futures price. Now, the weird thing that's happened, and it's never happened before in history, Greg, is that when the gold price was driven down last year to its lows in June of 2013, gold went into backwardation, and since then it's basically been in backwardation more than 50% of the time. Now, in recent history, the only other time the backwardation occurred was 1999 at the lows in gold and 2008 in the lows in gold. And after both of those backwardations, the gold price soared. So one has to logically conclude that the backwardation is only occurring at the moment because central banks are emptying out their vaults to try to keep the gold price from rising, to keep inflation looking low, to keep the banks appearing solvent, keep economic conditions looking good. And there's only so much gold that exists in the world. There's only so much gold that exists in central bank vaults. So the fact that this backwardation has occurred so long suggests to me that we're pretty close to the moment in time when the central banks are going to say, no more. We're not going to empty our vaults in the West anymore to ship gold to the East because we just, near rock bottom, we don't want to take that risk. It's like what happened in March of 1968 when the London Gold Pool, which was a cartel of central banks back then, broke up. They eventually threw in the towel. After trying to keep the gold price at $35 an ounce for years and years and years, they couldn't do it. They stopped selling gold into the market, and the gold price rose. It's the same thing that's going to happen this time around. And my guess is, Greg, it's going to happen this year.
Is it going to be a bigger scale than 68? People weren't really thinking about gold. They said that the BIS said that the global debt is now $100 trillion. It was $70 trillion back in 2008 when it blew up, and of course the GDP is around 70 trillion, but now it's 100 trillion in terms of global debt, money printing in effect, because that's how money is put into the system. So is it going to be bigger than 68? Is it going to be the same size? Give me give me your handicapping of the size of this.
Well, the size is going to be big. Who knows how big it's going to be, but it is going to be much worse than 68 for basically two reasons. The problems are much worse than they are now, and those problems include the derivatives, which are literally trillions and hundreds of trillions of dollars of counterparty risk between the various players in the global financial system. But there's another reason why it's going to be worse this time around, and that's really the theme of the money bubble. People have lost sight as to what money is. Money is not something that comes off a printing press of a central bank. Money is something that comes from hard work. All goods and services in the world come from hard work. That's how we create wealth, and that's how we improve our standards of living. And that's also true for money. In other words, money is gold and silver. And that's the way it's been for 5,000 years, up to the last 40 years, when the U.S. took the dollar off the gold standard. And as a result, as a consequence of that decision, we've got, all these myriad of problems that we're trying to face today. The only way we're going to go back to it is eventually when the money bubble pops, people start to recognize, yes, that gold is money, silver is money, and that we ultimately have to have currencies tied to this physical metal in order to constrain the money printing of governments and central banks.
Or barrels of oil, or bushels of wheat, or diamonds, or farmland, or something.
Well, every tangible asset has some utility. Houses provide shelter, farmland provides food, oil provides energy, and ounces of gold provide utility as a means of economic calculation. We can use it for measuring prices. And most importantly, it holds purchasing power over long periods of time. That's why an ounce of gold still buys the same amount of crude oil it did 60 years ago. Because the amount of the supply of gold, this above ground stock, continues to accumulate it, and we hold it because it's money. We don't hold it because it's pretty. We hold it because it's money.
I'm going to circle back to your What to Do, the money bubble, your book, and what to do before it pops. But I want to just bring in this about China last year importing almost the entire global production. Now, I don't know if they got all the production, but the equivalent of the global production. And now, this is in 2013, and now there's news out that they're going to make their imports of gold even more opaque than they did. They're going to try to shield that. What does that mean to you? What's your interpretation of why they're doing that?
Yeah, China is very cleverly playing the system, and they're doing it as quietly as they possibly can. So the more secret they are in terms of their gold purchases and other transactions, the less likely they're going to raise the ire of the other global players in this fragile monetary system that we have in place. So I think, China is basically taking steps to prepare for, the inevitable collapse of the global monetary system as it exists today. And the fact that they're moving all of this gold from Western central banks into Asia, into China, is an indication to me that, gold is going to play a role in the international monetary system, just like it's done for 5,000 years, with the exception of the last 40 years. It actually even is still involved in the last 40 years, but, central banks and governments try to make believe it's not important anymore, but it is still very important.
China, if you take a look at China with the number 2 economy in the world now, I guess you could have to say it's pretty important. And they're doing this because they're trying to get the last remaining, is everything they can get before it blows. Is that the read on that?
That's my view, yeah. And they're doing it in such a way that they're doing it as quietly as possible. And you have to look at what China is doing. They're very, very clever. They're accumulating a lot of dollars because of the trade surpluses that are being generated in their favor. But they're not sitting there just with T-bills and T-bonds. They're actually out there spending those dollars as rapidly as they can. They're buying resources all over the world. They're trying to buy companies and corporations all over the world that produce resources. So what they're doing is they're taking their reserves and spending it, as opposed to, in contrast to, say, Japan, which, although it's no longer generating reserves the way it has, was just sitting there with T-bonds and T-bills. So China's taking a very proactive approach in managing these reserves and using the system to its advantage until the system blows up. But they're not going to take those steps that will cause the system to blow up, because they don't want to be blamed for that, which is only logical. So they're going to use it to their advantage and continue to accumulate gold.
And is this why they're trying to do that air security zone in the Senkaku Islands? Is this more of just a land grab, a physical asset grab, that kind of thing? Or what's behind that, you think?
Well, China is an oil importer, and there's supposedly good oil reserves in and around those islands. So there's some geopolitical issues as to why they want to lay claim to those islands, as well as to islands in the South China Sea that the Philippines also claims. If there is a weak point that China has, aside from the credit bubble that's been created there over the last 10 or 15 years, it's an importer of oil. And that's always a vulnerability for any country.
Your money bubble book, What to Do Before It Collapses. What do you do before it collapses? And and how long do we have? Because I thought 2013 ended up being a gift. I had some guests on, but most guests thought it would blow then. I had one guest, Catherine Austin Fitz, said, no, slow grind. She was right. And but what do you think this year?
Yeah.
How long do you think we have, and what do you do before the money bubble pops?
Well, nobody can predict the future, and all we can do is to prepare for the future, and that's what the book is all about. We're definitely heading toward the cliff, but when we go over the cliff, we don't know. It could be next month, it could be next year, it could be in 5 years. But as long as we're headed in that direction, sooner or later we're going to go over the cliff like we did in 2008. Now, they saved the system in 2008, but I don't think this time around they're going to be able to save the system. So you have to prepare for it. And the way to do this, Greg, is you have to recognize that wealth comes in two different forms. You have tangible, real wealth, the things we discussed before, like farmland and timberland and houses and things of that nature. And then you have financial wealth, money in a bank account and, insurance policies and things of that nature, T-bonds, that are denominated in terms of a currency and come with counterparty risk. And as the currency collapses, in the Austrian School of Economic Thinking, you have what's called a crack-up boom. And people exit the currency and buy things because money, just like any other good or service, has a function of supply and demand. We talk about the M's, but we tend to ignore the demand for money. We talk about M1, M2, M3, but we don't focus on the demand for money. But the demand for money is even more important than the supply of money. And if you look at what's happening in the collectibles market, antique cars are going through the roof, paintings are going through the roof. And if you look at real estate in certain places around the world that are perceived to be safe havens, like Singapore or here in London, prices of those things are going through the roof. And the reason is the super rich get it. They don't want to have money in a bank account. They want to own things. And so they're going after all the things they can possibly acquire, and they're paying big bucks for it because they want to exit out of currency. And this is the beginning of the crack-up boom, in my mind. And it starts with people who get it first, and then it eventually grows and gains momentum. And that momentum will build until eventually the currency collapses. So we're early into the crack-up boom, but the answer to your question about what do you do for it is focus on owning real wealth. Don't focus, avoid T-bonds, avoid T-bills, avoid any kind of financial asset. If you're going to own shares of a company, own shares of a company that produces real wealth, companies that are involved in agricultural business, oil wells, mining, and things of that nature. Avoid shares of companies that are involved in financial wealth, banks, credit card companies, and things of that nature. It's spelled out in more detail in the book, but those are the basic themes.
Yeah, so for little people who don't have enough money to buy gold or silver, I guess they should, if they don't have enough money for gold, ratchet down to silver, and then maybe you should buy toilet paper and paper towels and tires for your car, and go buy yourself about 5-quart jugs for oil, some new filters. Fix your house up. Is that the other play? Stock up on everything you need and buy?
Yeah, that's typical of what happens in a crack-up boom. But, for the average family, the first thing you have to do is focus on your shelter. Make sure that your house and your land are secure. And then start focusing on other types of tangible assets once you know that your shelter is secure. And those other tangible assets can be everything from money, like gold and silver, to things like, farmland, to even, things that you use around the house, because prices are going up. They're going up at rates much higher than what the government is reporting. So you're better off owning, extra tubes of toothpaste, buying them at today's prices than buying them, 6 or 9 months down the road.
I got it. James Turk of goldmoney.com. Also the new book, The Money Bubble, and What to Do Before the Bubble Burst. I believe that's the title, right?
What to do before the bubble pops.
Before the bubble pops. Great. Good deal. Thank you so much for joining us today on USA Watchdog to let us know what's going on in the gold market and the coming crack-up boom.
Thanks very much, Greg.